Hi, good morning. Welcome to today's session. It's a last minute information that today we are starting a session. Hope in the future, like we'll be doing a lot of sessions in a continuous basis. Yesterday I was thinking since today is a holiday, I thought of doing a session on different topics. Same way in the future also, you will be seeing different topics emerging from Money Mind Investments. Maybe I'll try to keep you all posted a little ahead than what it is like a 1 day or 2 day basis. Yeah, so let me go to the session first. So today we are going to discuss on three different topics actually. One is as you all are informed, one is recovering your EMIs through SIPs actually. And second topic is limited SIPs. And third is how can you invest under 1 year and for a time period of 1 to 3 years actually. So debt funds, generally, we do it as an asset allocation pattern, as we all know. But you can deep dive into debt funds according to the time what you have actually, which is under 1 year. In under 1 year, you have different categories actually, 4 to 5 categories under 1 year. And in 1 to 3 years, you have 1 to 2 categories actually. I will cover each of the categories. So first is recovering your EMIs through SIPs. So in this case, I've taken a loan amount of 50 lakhs. Any house or any generally in cities, easily it is costing somewhere around 75 to 1 crore or 1 crore plus actually. So taken a value, I'm assuming a house loan here. So the total outstanding is 50 lakhs and rate of interest, I am assuming it as 9%. Loan tenure as 15 years actually. In this case, the total EMI is 50,713 rupees for another 15 years, for another 180 months actually. And the principal repayment is 50 lakhs, interest repayment is 41 lakhs actually. So totally, along with the interest, he or she is paying 91 lakh 28,399 rupees. Let's round it up to 91 lakhs. For the same outstanding amount, 50 lakhs, someone is paying an EMI of 50,713 rupees. For this, if someone has to get back the money, means get back 50 lakhs of outstanding as well as 41 lakhs of interest repayment completely back. That is getting 91 lakhs completely back. Requires 19,180 rupees as a SIP. So roughly 20,000 rupees SIP, which is 37.82% of the EMI amount, which is 50,713 rupees in this case actually. If someone is ready to shell out almost 38% of the EMI money towards SIP to get back the entire outstanding, which is entire money commitment, which is principal plus interest, which is totally 91 lakhs, he or she can opt for 19,180 rupees SIP along with the EMI, whatever they are committing. Best thing is not to have an EMI. Suppose in today's scenario, it's a little difficult. It is better said than done to not live without EMIs. But if he or she has a commitment of a running EMI, they can opt for an SIP, which may in turn give their money back overall. That's the overall process. See, in this case, I've assumed the 15 years and 50 lakhs as the outstanding and 9% as the interest. As you all know, for different commitments, for different, like for housing loan, there is an interest rate. For business loan, there is an interest rate. Like buying a car or buying a bike, car loan, etc. These loans has an interest rate and a tenure actually. We can feed in all the details on a case-to-case basis actually. As you all know, rate of interest is not fixed, it is flexible. Flexible rate is what is mostly we get in the market actually. So we can apply interest rate on the higher side and on a case-to-case basis, we can give the input of the details actually, and we can get this number accordingly. In some cases, the loan or the SIP to EMI could be 20% or 25%, or in some case, it could be higher than this, like 40, 45, 50% of the EMI amount. It varies upon the total number of years and the outstanding and the interest rate actually. So that's all about this part, EMI versus SIP planning. On a case-to-case basis, we can work on this. Yes. And now I will take you to limited SIP. There are three different calculations here. So generally, whenever I talk about SIPs, or in general, whenever you hear about SIPs, we'll talk about like investing from today, this month, until a particular month of 2030 or 2035 or 2040, 2023 to 2040. Or we'll assume it as doing an SIP for 120 months or 180 months or 240 months. Yes, this is a popular narrative that generally we'll hear from the market actually, and that's a beautiful concept. SIP is a beautiful concept, as we all know. But at the same time, SIPs can be looked at a different scenario as well, like this. Like in this case, 10,000 rupees SIP is planned for another 10 years. So 10,000 into 120 months actually. And we are deferring this investment for another 10 years. What it means is, from 2023, I'm going to invest till 2033. And beyond 2033, I'm not going to give a fresh money into the SIP. No, I'm not going to give any fresh money into the SIP. I am going to extend my investments for another 10 years. Whatever is the money accumulated with the compound interest, I am going to leave that money as it is. I'm not going to do a new SIP, but I am going to continue my investments for another 10 years. Suppose, assuming I'm 40 years now, I am leaving this money, I'm doing an SIP for another 10 years, and I'm leaving that SIP as it is with the compound interest for another 10 years. So in this case, if the rate of growth is 10%, the total output that I'm going to get is going to be 52 lakhs 25,000. And in scenario 2, the total output, the total answer that I'm going to get is 69 lakhs, assuming a rate of growth of 12%. I've assumed two scenarios here actually. One scenario is giving me 52 lakhs, another scenario is giving me 69 lakhs, almost 70 lakhs actually. In this case, my investment is only 1 lakhs. And that is growing to this point, this much amount. Now, I've taken a different calculations altogether. In this case, I've assumed a target amount. In previous case, we didn't have a target amount actually. I didn't assume any target amount. But here, in this case, I've assumed a target amount of 5 crores actually. 5 crores. For achieving 5 crores, I have only 5 years, and I can defer the investments. That means let me not touch the investments. Let me not redeem the investments for another 15 years after the initial 5 years. So in this case also, the total time period is 20 years, but I have a target amount of 5 crores. Initial 5 years, I'm going to do the SIP, and 15 years, I'm going to wait for the money to grow, for the investments to grow. Here you can see at 12% interest rate, I love to invest 1,12,000 rupees 631 every month for another 5 years, which is this amount into 60. 1,12,631 into 60, which is almost 67 lakhs I'm investing, 60 plus lakhs I'm investing here in this first scenario. In second scenario, I've assumed the rate of growth at 11%. In this scenario, 1,32,000 into 60 months. So totally, I would have spent 79 lakhs. I would have invested 79 lakhs. you can assume here the rate of growth is little high. So the total investment commitment is little less. Here the rate of growth is 1% lesser than this. So here my investment is 79 lakhs 25,000 rupees plus. So if you have a target amount like 5 crores or 10 crores, and if you have a limited period to invest, like peak of your career, peak of your income career, if you want to invest, make use of the initial 5 years, you can make use of the initial 5 or 10 years. You can do the SIP only for a limited period, and you can wait for a good period, and you can take the money out. You can achieve your target, provided if the market is good. Now you can wonder why I'm using 5 crores here. I'll just show you a small example. I'll just show you a calculation why I've used 5 crores actually. I'm going to a retirement calculator. I'm assuming certain things over here. So what I'm assuming is my age is 40. I would like to retire at age 60. I'm leaving it as it is. Expected life expectancy is 80. Current household expenses is 50,000. I am changing it to 75,000 rupees. Expected inflation 5. And the expected rate of return on your investments is 12%. Let me assume it that way. How much investments you have now? 1 lakh is mentioned here. Let me change it to 1,10,000 rupees. And post retirement, I would like my money to grow at 6%. So these are all the calculations. Now you can see 75,000 rupees is my current household expenses. With an inflation of 5%, my household expenses will go to 1,98,000 rupees the moment when I am retiring. And post-retirement, these are post-retirement years. 60 I am retiring, and life expectancy is 80. So 60 plus 20 years I have. 20 years of post-retirement years I have. Here, my expenses of 75,000 rupees is jumping to 5,02,000 rupees in the future. That is when I am 80. In a lifetime, I'm experiencing almost 4 to 5x or 6x of my overall monthly expenses shooting up because of inflation. So for this inflation, I need a money supply or a money capacity. That capacity is what is 4 crore and 34 lakhs. Suppose if I'm changing my monthly expenses to 1 lakh, it is jumping to 5 crore and 79 lakhs. This is the reason I have applied a 5 crore as a future amount actually. This is minusing my 1,10,000, whatever I have today. That money might grow to 10 lakh and 61,000 rupees. Minusing that, I require 5 crore and 68 lakhs. This is the reason I've feeded 5 crores as the target amount for the future actually. Hope it is clear actually. And again, limited SIP, I've made a different calculation. In the past calculation, we have seen limited SIP with a target amount. In this again, I've taken out the target amount. This is simple limited SIP calculation, wherein monthly SIP is 10,000 rupees, SIP is 10 years, deferment is 10 years. So 12 lakhs is the investment, and 12 lakhs is growing to 52 lakhs and 69 lakhs in the future. 10 and 12% is the scenarios. Scenario 1 is 10, scenario 2 is 12%. So this is about limited SIP. I've covered 2 parts of the session. One is recovering your EMIs through SIPs. This part. And another part is limited SIP that we have seen 3 different scenarios I've applied, and we have seen that. Now let me open the retirement planning again, retirement calculator again. I'll just show you as an input. Actually, 40 years is my age, 60 years is my age at retirement, 80 is my life expectancy. Current monthly expenses is 50,000. Expected rate of inflation. In this calculation, I've assumed 7. In the past calculation, I've assumed 5. In this calculation, I'm assuming 7%. Expected return on your investments is 12. Current savings 1 lakh. In the last calculation, I've assumed 1,10,000. In this, it is 1 lakh. expected return on corpus, that is post retirement, whatever money I have acquired, that money has to grow at 6%. That is the overall idea. Money is invested throughout the lifetime, but till retirement, that's 40 to 60, it is assumed at 12%, and 60 to 80, the overall return is assumed at 6% actually. And 50,000 is the monthly household expenses. Totally, future expenses starts from 1,93,000. Current investment is 1 lakh. Future value of current investment is 9,64,000. So future corpus amount needed to meet the expenses is 5 crore 10 lakh 81,000 rupees. Number of years I have to save is 20 years. This 5 crores I have to achieve either through a lump sum or through a SIP or through a lump sum plus SI. Either ways. If it is a SIP, it is 50,000. If it is a lump sum that I'm planning to invest, I should invest 51 lakhs today itself. If I don't have 51 lakhs today, I can go for 50,000 rupees SIP. Or if I have part of the amount here, if I have 25 lakhs for lump sum, I can invest 25 lakhs here. And obviously, my SIP commitment will become little less. My SIP commitment will become as 25,000 rupees. I can do a combination also. So next, I will show you debt funds. Sorry, I'll show you a combination also. Yeah. So in this case, what I've assumed is someone has a SIP amount of 10,000 rupees that they are ready to invest through a SIP, as well as he or she has a lump sum money to invest. The overall tenure is 10 years. So in this case, 10 lakhs is invested as a lump sum, and 1% of this lump sum money, which is, just a second. Ten lakhs, I have a lump sum, and 10,000 rupees, I have an SIP. So SIP is assumed at a growth rate of 10%. Lump sum is assumed at a growth rate of 12%. So 10 lakhs is going to grow at this rate. SIP of 10,000 is going to grow at this rate. So overall SIP fund value could be 20 lakhs 14,000 rupees, which is 10,000 into 120 months. 12 lakhs would have grown to this much, and lump sum of 10 lakhs would have grown to 31 lakhs. So totally 51 lakh 20,000 could be the overall output actually, overall future value of both lump sum and SIP. The reason why I'm showing you this is not necessarily the SIP investors has to do only SIPs, and the lump sum investors has to do only lump sum. I could see a lot of same pattern continuing actually. Mostly lump sum investors are continuing only with the lump sum, and they are missing out the opportunities of SIP. And the SIP customers are only investing in SIPs, and they are missing out the opportunities of lump sum what it is offering. So if someone could do both, if someone could make use of both lump sum and SIP, it could result in a better future value. Obviously, every method has its own pros and cons, but if he or she is able to continue the investments for a longer period, both are going to be benefiting them in the future. Actually. That is the basic, that is the overall idea of this section. So now let me go to the debt fund. This is a combination which I've shown. I'll show you how debt funds are working. So if you have a period of 0 to 1 years overall, how you can plan your investments in debt mutual funds. A debt mutual funds in general, we could have heard like it is a low risk product or a low return product, or it goes well with asset allocation. Yes, these are all true, but of course, debt mutual fund as such offers lower returns, as well as it is little bit lesser riskier than equity funds. If you see historically over a period of 10, 20, 30 years, generally it has been proven that Debt funds are giving little bit lesser volatility. So of course, it gives lesser returns, but it gives lesser volatility and lesser drawdowns or lesser negative impact when the economy is in a bad shape. Equity gets hit, but debt funds are much better position actually. So if you have a 0 to 1 years period, again we can segregate that into 1, 2, 3, 4, 5 categories. If you have like some of the expenses are yearly in nature actually, like school fees, insurance premiums, service of appliances and vehicle. Washing machine goes for a repair, mixie goes for a repair, grinder goes for a repair. Some expenses demands a yearly expenses by nature actually. And vehicle, generally we give a vehicle for service yearly, once or twice we give our vehicle for service, be it bike or car. So for those expenses, definitely one can use the make the best use of debt funds actually. In this, suppose if someone has a time period of 1 to 3 days or 4 days, if someone has 5 lakhs or 10 lakhs now, and he or she doesn't want it for another 3 4 days, they can consider overnight fund, because the maturity of the papers are only 1 day in a overnight fund. And where does the money invest? We are giving the money to a mutual fund. A fund manager is managing the money. A fund house is managing the money. Where is the money invested? It is invested predominantly in major investments are in three areas: commercial papers, certificate of deposits, and T-bills, treasury bills. These are very short term in nature. Most of these are maturing within a year. And considering an overnight fund, the overall maturity should be within a day. That liquid it is actually. And if it is a liquid fund, this is a popular category. If it is a liquid fund, it matures up to 91 days actually. Again, commercial papers and certificate of deposits and T-bills. Ultra short duration fund. This fund matures between 3 to 6 months. If you see school fees, you can pay it in 2 installments, and in some schools they are getting 3 installments also. So part of the money, if you are paying to the school, part of the money you can invest over here, and you can get a little benefit, and you can take out that money and pay the school fees actually. And insurance premiums, again, half yearly premiums are there. So you can consider an ultra short duration for that. Same way, commercial papers, certificate of deposits, and T-bills, which is maturing at 3 to 6 months. A combination, if you see the aggregate, overall 3 to 6 months would be the overall period that it's an ideal investment period in an ultra short duration fund, because the overall macular duration or the overall maturity of the papers are 3 to 6 months. Low duration is between 6 months to 1 year. If you have a period of 6 months to 1 year, you can consider this. Money market fund is in investments in commercial papers, certificate of deposits, and T-bills, which is maturing up to 1 year. That is called money market fund. So according to your timeline, if you have 1 day to few days, you can consider an overnight fund. If you have 3 months time, you can consider a liquid fund. If you have 3 to 6 months, you can consider an ultra short duration. If you have more than 6 months to 1 year, low duration fund. If you have a time period of maturity up to 1 year, just a second. Hi, sorry for a small break actually. Let me show you the pending session. So again, back to the topic, we were discussing on debt funds, which is maturing within a year's time. We have seen different categories in the debt funds actually, which is like maturing, the papers are maturing within a day, called overnight, and liquid fund, wherein the overall investment instruments in the fund maturing at 91 days, and ultra short duration fund, wherein the overall papers are maturing at 3 to 6 months. Low duration fund, where the papers are maturing at 6 months to 1 year. and money market fund, wherein the papers are maturing at up to 1 year actually. And there is a category called short duration fund actually, wherein it is maturing between 1 to 3 years. The papers in the short duration fund is maturing between 1 to 3 years. Earlier, the predominant investments have been made at commercial papers and certificate of deposits. You can see it here, and T-bills as well as maturing within 1 year. Last till the money market fund, we have seen that. Short-term fund is the papers, the instruments are a little bit different, wherein the money is invested in predominantly in corporate bonds and government bonds, as well as commercial papers and certificate of deposits and T-bills. Little bit extra for the cushion, for the comfortable position actually. But predominant investment is on corporate bonds and government bonds, wherein the maturity is between 1 to 3 years. This fund could be used for short-term expenses like vacation. Like you have a vacation planned every 3 years, you can use this. Short-term capital gain requirement for business investments. If you have a business requirement after 3 years or every 3 years, you can use a short duration fund. Higher education. Suppose if your child is at undergraduation right now, post-graduation is easily away after 3 years or 4 years, or in some case it is 5 years actually. So for higher education, if you want to build a corpus, if you know clearly 3 years, 4 years, 5 years are there, if you want an exposure of conservative or moderate risk appetite, if you have a moderate risk appetite, you can consider a short-term debt fund actually. Or if you want to simply roll over the capital, wherein 3 years you are waiting for the capital to give a value. Yes, 3 years you're waiting, you've got a future value with the interest. And if you want to roll over the capital, if you don't want the money after 3 years, if you want to carry it over for 1, 2 years or 3 years, you can do it after that, which is 3 plus 3, 6 years also, you can wait at a short duration fund. And you can do it as an asset allocation. Like you have money in your equity funds, as well as you can have a little bit of money in debt funds as well as, or equal weightage to debt funds also, depends upon the individual's need and the individual's risk appetite actually. 50 you can have in equity, 50 you can have in debt fund, or for 75 you can have in an equity fund, and 25% you can have it in a debt fund. For that, for the short-term needs, you can use a short duration fund, or you can use a short duration fund and you can roll over the capital in the future also. It is completely up to your choice actually. So these are all the different categories. If you want your money to work within 1 year, you can consider all these major categories. If you want your money to work for 1 to 3 years specifically, you can consider here. You can consider these type of funds actually, short duration fund. Again, individual choices and the investment preferences and the risk appetite will vary between individual to individual. So accordingly, one can consider the overall investment section. Thanks a lot for coming to the session or for the recording. Thanks a lot. You can expect more sessions from Money Mind Investments in the future also. Thanks a lot. Have a good day. Bye.